Hey guys, welcome to my YouTube channel. Here I'm back with another informative video. So the topic of our video is how the 2025 US tax bracket affect your income and how to maximize your refund legally. So wondering about 2025 tax brackets and how they'll affect your tax. In this article, we'll break down how to determine the tax bracket you are in and the new bracket threshold for 2025 and tips to reduce your taxable income and common tax credits you may qualify for. So the key takeaways are your 2025 tax bracket depend on your taxable income and filing status which affect how much of your income is taxed at each rate. Second one is contributing to retirement accounts, health saving accounts, or FSAs can reduce taxable income and may lower your tax brackets. You can reduce your taxable income by claiming either the standard deductions or itemized deductions depending on which lowers your tax more. The other one is common itemized deductions include mortgage interest, property taxes, state or local taxes, charitable donations, medical expenses, and some disaster losses. The next one is tax credits provide greater savings than deductions by directly reducing tax, with refundable credits potentially increasing your refund. A few common tax credits you may qualify for include the earned income tax credits, the child tax credits (CTC), and the American Opportunity Tax Credits. A Jackson Habit Tax Pro can guide you on the deduction credits and strategies to maximize your tax refund and minimize tax dues. So, how to find what tax bracket I am in or you are in? The tax bracket you are in is determined by two things. The first one is your taxable income, and the second one is your filing status. Your taxable income is the portion of your income subject to tax. The US has a progressive tax system, which means that the more you make, the higher your tax rate will be. However, it is important to keep in mind that the highest rate you pay, which is called the marginal tax rate, only applies to the income in that specific tax bracket. For example, if you are single filer in 2025 and you have a taxable income of $60,000 a year, you will be in the 22% tax bracket, but you will be taxed at 22% on only $11,524, which is the portion of your income over the threshold of $48,476. You will be taxed at 12% of your income between $11,926 and $48,475 and 10% on income at $11,926 and below. To find your effective tax rate, which is the rate your overall taxable income will actually be taxed at, you will need to sum up the tax rate on each portion of your taxable income. Then you divide that by your total taxable income. In the above example, your effective rate would be 13.52%. Your filing status is also important because whether you are single, married, filing jointly or separately, or as a head of household, it determines tax bracket thresholds. It also determines your standard deduction amount as well as which tax credits you qualify for and amount of credits you can take. These are the tax bracket 2025 for the single filers, and these one are for the married filing jointly, and these one are the for married couples filing separately, and these for the married of head of households. And the next one is how to reduce your taxable income. There are many ways you reduce your taxable income and therefore potentially lower your tax bracket and therefore your tax rate. The first one is to contribute to retirement accounts. If you are employed and have a 401k and a 403b or a traditional IRA, or you're self-employed and have a SCP IRA or simple IRA, you can lower your taxable income by making pre-tax contributions to your retirement accounts. Keep in mind that IRS sets contribution limits to retirement accounts each year, so consult with our tax pro to make sure you are making the most of your retirement plan without exceeding the limit. The second one is contribute to a health saving account. If you have an HSA health saving account, contributing the maximum amount possible each year is a great way to lower your taxable income contributions are made with a pre-tax dollars, plus the funds grow tax-free and you wouldn't have to pay tax when you see the funds for qualified medical expenses either. The third one is contribute to a flexible spending account FSA. If you have a flexible spending account, you can lower your taxable income by contributing to it. With pre-tax dollars, you can use the funds tax-free for certain medical and dental expenses, and also you can take the advantages of tax deductions. Tax deductions lower your adjusted gross income AGI, which is your income with some adjustments by a specific amount, which also lower your taxable income. You can either choose to take standard deduction or itemize your deductions, but you cannot do both. A Jackson Habit Tax Pro can help you determine which options will result in the least tax or the biggest fund. Then we come with standard deduction by filing status 2025. Each year, the standard deduction amount is set by the IRS. The amount you can take is determined by your filing status. Here's the breakdown of the standard deduction amount for 2025 for each filing status. So, for single filing status, the standard deduction amount is $15,750. For married filing jointly, the standard deduction amount is $31,500. For married filing separately. The standard deduction amount is $15,750, and for head of households, the standard deduction amount is $23,650. So, what are the itemized deductions 2025? If you choose to itemize your deductions, make sure that you keep careful records of your expenses, including receipts. Here are some of the most common itemized deductions. First one is the mortgage interest. The interest you pay on loans for your main home or a secondary property are mortgage interest. Then come property taxes, state or local property taxes, state and local income taxes, or the sales taxes. Either the amount you paid in state or local income taxes or your total general sales tax amount comes in the state and local income taxes or sales taxes. And then are the charitable donations contribute to qualified charities, which can include cash donations and certain types of non-cash gifts. And then medical and dental expenses, out of pocket medical and dental expenses that exceed 7.5% of your AGI. Personal property taxes, taxes paid on your personal assets like cars or other vehicles. Casualty and theft losses are the losses from federally declared disasters that were not covered by insurance. And then common tax credits you may qualify for. Tax credits do not reduce your taxable income. However, they provide an even bigger tax benefit than deductions by directly reducing your tax. Here are some common tax credits you may qualify for in 2025. First one is the Earned Income Tax Credit EITC. The EITC is for low to moderate income workers and families and offer a maximum credit in 2025 from $649 if you have no children to $8,046 if you have three or more children. It's also refundable, which means you'll get a refund for any credit left over after reducing your tax to zero. The second one is child tax credit CTC. The CTC provides up to $2,200 a child under 17 and with up to $1,700 per child refundable. The amount you qualify for depends on your income and phases out for higher earners. And then comes American Opportunity Tax Credits, the AOTC Sports College expenses with up to $2,500 per eligible students for the first 4 years, including up to 1,000 refundable. Eligible students must be enrolled as at least half time in a degree program. And then comes Lifetime Learning Credit LLC. The LLC covers education expenses for college or career development and is worth up to $2,000 per return. And then comes Child and Dependent Care Credit, Daycare Credit, and then also Premium Tax Credit and the Savers Credit. The Savers Credit rewards your retirement contributions with a credit up to 10%, 20%, or the 50% on the first $2,000. Hope this video will be very beneficial for you. So kindly subscribe my channel. Goodbye.